Welcome to the Halftime Report, everybody. I am Brian, in for Scott on this Friday, and front and center, yeah, you know, stocks again at record highs. Another key inflation report showing that prices continue to cool. Your investment committee today making a lot of moves in this market. We're going to give you all the names, all the trades, the buys, the sells, and everything. Joining us for the hour is, and everybody's on set today, I love it, Jim Leventhal, Jason Snipe, Brenda Vingello, Kevin Simpson. We got a couple of time zones in a couple of different states here covered. Who says everybody's work from home on a Friday? All right, let's go in and check these markets. As Sarah and David noted, these markets are at record highs. We just continue to grind higher. I think it's the 32nd or 33rd record high for the S&P 500 this year. You got utilities. They remain hot. Power demand off the charts. Industrials are hot. Materials, they're all hitting record highs as well. Let's jump right in. Jim Leventhal, I mean, this is a... By the way, it's not just us. Europe has done well, but not as well as us. This is a juggernaut market. It doesn't seem to be able to be stopped. What is this latest leg higher being powered by?
Well, it's being powered, Brian, by the rotation, right? I mean, obviously, everything has been performing this week. It's hard to find blemishes, but you're seeing much outperformance from cyclicals, from small caps, the things that have been very much left behind over the last several years as tech has powered forward. I very much think that continues both on the back of Fed rate cuts as well as what's going on in China, which should stimulate demand for materials, energy, and industrials. We note that the equal weight S&P 500 has set a record today. That's great. Still looking for a record, and frankly, far off from it is small caps, and I think that they will catch up. You got another 10% for it to get back to the high that was set. I think it was May of 2021. Maybe it was November. Who cares? It was a long time ago. It was 3 years ago. Small caps have labored, and as we continue to get good economic data here in the U.S., which we've gotten all week, it appears more and more clear that small caps' top-line revenues should stay intact, borrowing costs should come down, and frankly, the multiple, which is very low on small caps, should expand. So take away from all that, cyclicals and small caps for me.
Well, that's a natural transition, Brenda, to you, because you've gotten a little more into mid caps, into small caps. You know the movie like Waiting for Guffman? It's waiting for good. The waiting is the hardest part, Tom Petty. We've been waiting for the small and mid caps to finally catch a little bit of a bid, a little bit of fire. I think we're kind of getting there. You're optimistic.
We're optimistic. I mean, it has been a long wait, to your point. We've been overweight small and mid cap all year long. Yes. But I think we saw, ahead, I think there's been some frustration because, well, we had this rate cut and now they haven't been performing as well, although we've seen that change a little bit in the last few days. But I think we saw it ahead of the rate cut, right? This current quarter to date, small and mid cap are definitely outperforming. But to Jim's point, I still think we have a long way to go. They're definitely undervalued versus other parts of the U.S. market, more tied to the domestic economy, which continues to be strong. So I do think there is more room to go there. Our preference is on the mid-cap side because at mid-cap universe, you have less unprofitable companies. But I think either way, it's a good place to be right now.
Yeah, and if you look at it, so the SML, the small cap 600, is up double what the S&P 500 is up in the last 3 months. Mid caps, not quite that good, Jason, but they have been outperforming. Are you a believer? Are you a believer?
I would like to say I am, because I think in an easing cycle, obviously costs are coming down, and I think these names can perform. I think what I'm more excited about, however, is something that Jimmy mentioned, is the RSP. RSP is absolutely in an uptrend. It's up 9% for the quarter. GDP was in line this week. PCE was obviously softer. We'll see labor next week. I think that's a number that the market is really paying attention to. As we've seen, the disinflationary narrative is obviously intact with PCE this week. With CPI, PPI has also been softer. So there's a lot of things to like in the market, and I think that's what the catalyst that we've seen thus far.
Just real quick, you mentioned GDP inline. You mean for the prior quarter?
Exactly.
We got an update from Atlanta Fed today on this quarter, and we're pretty late in the quarter, 3.1%. Now, look, there's some variability or some inaccuracies in it, but that's still a darn good number.
100%.
Well, if you throw 10 trillion in debt at an economy in 3 years, I would hope that you would get some GDP growth.
I would too.
Yep. That's for a different show. So we got a lot of stuff coming out next week. Okay, I'm not a big fan of the jobs number because they keep getting revised down, but it's still important. We got PC. Is this a market that is priced to perfection? Because if it is at whatever 23 times forward earnings, whatever the number is, we better have all those economic numbers next week come in really well.
Yeah, Brian, I mean, everything has to hit on all cylinders. It would be hard to argue that we're not priced to perfection, or at least the upper bounds if you believe in valuations and fundamentals. But for us, it's everything hitting perfectly, which for most of 2024 has happened, as hard as it is to believe. And to Jason's point, next week the labor market is important. I realize the revisions last time made last month's look even worse. But as a whole, Brian, you're still talking about 116,000 job creations for each of the past 3 months. That's not recessionary. In normal times, that's
That was
good.
below trend.
It's still not
It's not great.
3% GDP and 100,000 job creations. We need to see that. Otherwise, the alternative is you fall off a cliff of growth, you go into a recession. So this is what a soft landing feels like. We also have manufacturing and service PMI next week. That gives you the growth. We had inflation today. It's a shock to me, but good news is going to be good news, and we'll root for it next week.
Let's talk about Meta. We're going to go individual here, Kevin. You got the glasses, by the way. He's got the new Meta glasses, the old new Google glasses, whatever you want to call them.
Yeah.
You bought Meta because now they pay a dividend. Now you can own them. Listen, I kind of am liking based Mark Zuckerberg. That's a different issue. His hair is all crazy. He's wearing different stuff. He's fighting. That's probably not the reason you've had it. You bought Meta. What is the reason?
Well, I think a CEO does matter, and because you like him, that weighs in and checks off.
Like the new Zuckerberg, right? He's kind of just like, I'm rich and I don't care and I'm gonna do what I want. But that's probably not for the stock.
Whatever he's doing, it's working, because if you look at that balance sheet, it's as clean as a tech company can be. Their debt's down. Instead of just buying every company willy-nilly in acquisition phase, they're returning cash to shareholders. They reduced their float by 10% over the past 3 years. They've initiated a dividend, which to your point, Brian, is why we can own them. Our enhanced dividend strategy requires companies to own dividends. So you look at it and you say, well, where have you been the past 10 years? Now you're buying Meta. We're buying Meta because it's now part of our universe. It's in a category of stocks that we can invest in. We love the growth. We love the margins. And as funny as the hardware is, I mean, they're going to give Apple their run for their money. These products are good, and we think they're only going to get better.
Anybody else got a take on Meta? Zuckerberg? Tuxedo surfing with a Coors and a flag.
No, I mean he's trying to be the next Jeff Bezos. You can see it. Social media is not my thing, Brian. Just it's one of those things people can have.
About what they do. If you just looked at Meta, to Kevin's point, from a balance sheet perspective, there was no name on the top. There was no company description. You had no idea what they did.
If I had no idea, I would agree with the valuation. I said that to Kevin earlier today. I can also find a lot of other companies in different industries that have exactly the same numbers. So given that, I'm not going to invest in something that I wake up in the morning and I don't like myself because I'm invested in it.
I will say with Meta, though, if we think about the digital advertising universe and where it's going, we think they're incredibly well positioned. But there's a lot of questions about the Googles of the world and traditional search and how that's all going to shake out. But we do think that on the digital side, Meta is already using AI very effectively to drive better returns for advertisers. And on the consumer side, I think they've done a great job of making it very palatable for consumers to sit and watch ads that they don't mind watching. It's part of the whole experience. So
we need the Vingello index, because you live out there. Just go to the Meta parking lot and see if there's a lot of really new Porsches.
Yeah.
There's a lot of, that's what I do. I'm not joking. When I went and saw Genentech years ago, and I looked at all the cars in the parking lot, and they were all $200,000, I was like, my gosh, this company's doing well. All right, so let's talk about, watch this transition, Brenda. Okay, you recently bought Eaton. You sold Boeing and bought Eaton, okay? Eaton's a big part. What people don't realize about Eaton, maybe this is part of your thesis, maybe it's not. Eaton is a massive part of the data center energy infrastructure. They do all the kind of the boring stuff. Facebook needs a lot of AI energy infrastructure. Part of the thesis or no?
Yes, absolutely part of the thesis. That, Eaton's been around forever. It's been listed on the New York Stock Exchange more than 100 years, but they have about 30% market share within the electrical part of their business, and that is where we think the most exciting growth opportunities still lie ahead, not only for this intense need for more electrification, utilities needing to upgrade, the transition to renewable energy. There are just so many things, onshoring of supply chains. There are a lot of different elements that we think are going to contribute to their business growing and being incredibly relevant in this environment. So that is why we like it. We sold Boeing. we've held on.
Why did you? By the way, there's probably 100 reasons, but what is there one overarching
Final
reason?
straw. Yeah.
What is? Okay, go into that.
We've been incredibly
What is the final
patient.
straw?
But I think when you look at what's happening with the labor negotiations right now and the impact to cash flow and their need to potentially come back to the market to raise more capital, we just think there's more opportunity elsewhere. We still think over the longer term, the company will right itself at some point, but in the interim, we think there are more opportunities
Just
elsewhere.
sick of it. Yeah.
Brenda, I think you're absolutely right. And, I think all of us as Americans want the company to succeed. But I look at the current situation and I see they're in an absolute no-win situation. Consider this. We know what they need to raise capital and they need to do it in the equity markets. They should do it right now at this price. I agree with you. It's down on the year. It's down big. But they should do it at this price. If they were to do it today or Monday, that would immediately throw a bone to the union who would say, well, you guys are flush with cash, put it in our pockets. In the meantime, they're locked in this battle with the union, which is going to further drive the stock price down, unless they clear it up, maybe in the next weekend they do that.
Right.
But they're between a rock and a hard place.
Yeah, and the risk that it continues to lengthen is just terrible for the cash flows.
So the only major American commercial airplane manufacturer, and they can't get out of their own way. It's kind of sad to watch. Okay, move on. Jason, energy. You sold energy.
I know.
My love.
Brian, I know. That's
I'm not saying you're my love, but the energy's my love. Could be.
Yeah. So, we had a small position in XLE. Commodities, commodities have been doing well outside of oil, right? Crude's down 10.5% over the last month. The XLE is down 6.2% over the last month. And for me, obviously in that ETF, 40% of the exposure is in ExxonMobil and Chevron. If you're going to be there, I think the fully integrated names are the ones to play. But I just think it's a little early for energy right now. I see obviously what's going on with China. We'll see how stimulative that is for demand. But we decided to move on and look for other places to mark because I think there'll be other opportunities.
Yeah. You could easily make the case for $50 oil if I had to, with a lot of potential new. And by the way, OPEC has a virtual meeting on Wednesday. They've got their big in-person meeting December 1st. A lot of talk about, is there going to be a market share war? I think the market is, fair to say, it's nervous, Jason. The oil, energy, infrastructure, people are just like, we don't know where prices are going.
Yep.
Traders are net short bearish of the paper contract. Yep. People are out. They're just out.
Yeah. And you're even seeing with production what the Saudis are doing, right? So they're going to come back.
Look, the fact that it hasn't rallied on this China news, whereas every other commodity tells you this is about OPEC. This is about OPEC.
Right.
And, the fact that they're abandoning, this, Brian, the fact that they're abandoning their $100 barrel price target.
They don't have a price target.
Okay.
Saudis don't have a price target.
You're right. The last official target was $20 to $25.
No, they don't. They do not have a target. I will say they do not have a target. But there's a lot of stuff in the FT and Reuters this couple days, and I'm hearing it. Trust me, from some of the OPEC nations, they're pinging me directly like we have no price target. But to your point is people are worried that if there's a market share war, we're going to get that $50 barrel.
The question is, has OPEC learned its lesson from literally 10 years ago? It was 10 years ago, November of 2014, that they said to heck with it. We're opening the spigots. We're going to try to drive the shale producers in the U.S. out of business. That didn't succeed. I don't know why they would try that again, especially when to balance their budgets at the national level. They generally need crude oil in the at least $60, more like $80 a barrel range.
And Kevin, I know you've got a point of view on energy, but this is my world. I'm going to look right in the camera. I'm going to say something because I talk to OPEC nations verbally, over text, WhatsApp, Signal, whatever. They're not going to defend a price target. I'm just going to look it right in the camera. There is no market share war coming. OPEC nations are not going to just fracture, at least as far as what I'm hearing. I'm just saying that. There's some other stuff in the media around it, but you heard it from me. I'll prove if I'm right or wrong. Anyway, Kevin, give us your view on energy in general.
Well, I'm going to use you as the source. I feel like that.
Don't do that.
Our thesis is the same. Now, I don't blame Jason for getting out of it. We've been trimming Chevron. We sold ConocoPhillips. We still have a small position in Chevron, a small position in Marathon Petroleum. We're getting a really nice dividend while we wait this out. We can write calls against it with any type of volatility, but our enthusiasm there has waned tremendously. But with our strategy, we're going to have an exposure there, but it's about as small as I can remember at the moment.
Yeah, it had its run.
Yeah.
Energy.
Exxon's up 18% year to date?
I know it's had a good run. It's well outperformed Chevron too. They're different. Everybody always lumps them together. They're different companies. But
is it too early for final trades?
Are you giving us a preview, a little taste?
I might be trying to sneak in 2-for-1 here.
I kind of like that. We call you, I know, Scott, they call you Farmer Jim. Maybe we should change that to Industrials Jim, because you're loving the industrials here.
Well, I am at the moment a cyclicals guy, and this is something I've been saying for quite some time. You know, probably people are tired of me saying this, but all those three infrastructure bills over the last 2.5 years are only just now starting to show up. You've got continued supply chain onshoring. And you know what? If you're building data centers, if you're building power plants, you need materials, you need energy, you need industrials. Industrials in the form of earth-moving equipment, in the form of transportation like railroads. So to me, that has been a long-term thesis. One day it will end. One day it will end. But right now, that's going to continue into the next year.
All right. You know what? Let's bring in Stephanie Link, because we got to talk. How can we not talk? China. Kind of the story of the week. Chinese stocks surging this week. The FXI is one of the biggest ETFs for Chinese stocks, having its best week ever. And one halftime committee members adding names of China exposure. That is, of course, the aforementioned and now on your screen, Stephanie Link, joining us by phone. Stephanie, what a week. Although you do wonder, with this kind of a week, are we selling into strength?
Hi, Ryan. It's great to be here. No, I think we're in the first inning of this whole thing. This is the most stimulus in China since COVID. Between the triple R cut, lower interest rates, cutting down cutting the down payment investment for investment properties, and they're committed for more. It sounds to me like this is whatever it takes moment in China, and they're focused on consumption stimulus. So I think it's time to buy and have more exposure. I think that portfolio managers are not exposed to China because it's been a terrible place to invest. So they've been right, but I think the tide is turning.
Yeah. Listen, we've seen China throw wads of money at everything in the past. They've got to do it. They've got a real estate-based economy, an interest rate-based economy. Beautiful pop. David Tepper, he was on Squawk this week. I'm sure you saw it, made a ton of money. But is this a long-term play, Stephanie? I mean, is this really like I feel like we've seen this picture before.
Right. Well, I don't know, but in terms of the time frame, it could be a trade, but I think for the time being, it is a trade for like the next 6 months or so. I mean, the triple R cut alone of 50 basis points with a promise of maybe doing another 25, that's going to be 140 billion in new lending. Lowering the interest rates on $5 trillion of mortgages is 25 billion. And again, as I mentioned, they're cutting to the down payment on investment properties by 10% to 15%. It's got to lead to better growth. If nothing else, it's stabilization, but I think it's going to lead to better growth. And that's why I want to have U.S.-based company exposure to China.
U.S.-based company. That leaves us with about 3,800 stocks to choose from, Stephanie. We don't have time for that. Can you be a little more specific?
Yes, I can. So Freeport-McMoRan is the poster child for China. The copper market is tight. For every 10-cent change per pound in copper, it's $200 million to cash flow to them. At $4 copper, they'll have profits of $11 billion. At $5 copper, $15 billion in profits. And this also ties right into what you guys were talking about in terms of Eaton and industrials and power and grid, because all that needs copper. Their net cash costs are coming down. They have a $5 billion buyback, and the stock trades at 6.9 times EBITDA versus 9.2 times for the 5-year average.
I just looked before we went down to the show, and I was on my fact set doing like a search for this week, see what was hot. I was shocked, and I look forward to getting the committee here on set into this as well, Stephanie. Las Vegas Sands, which you just bought, and Wynn are up 20% since Monday. Jim just he's doing fist bumps next to me on camera.
Overdue. It's long overdue, and Stephanie knows it.
But 20% gain, Stephanie. You bought Vegas Sands, but come on. What justifies a 20% gain in a week?
Because it's still down 2% year to date, and it has done nothing in the past year. And the reason it's done nothing in the past year is because the earnings have been disappointing. 63% of Las Vegas Sands revenue is in Macau. And I love Macau, but they're spending a ton of money on their properties renovating. That's going to come to a halt in the first quarter of next year. So I think they're going to continue. They will regain the market share that they have been losing. And in the meantime, their Singapore assets, which is 37% of total revenue, it's a gem. They're running at about 18 to 20% adjusted property EBITDA. The stock trades at 9.7 times EBITDA versus 28 times 3-year average. It's cheap. And I think you're going to see a recovery in the name.
Stephanie, it's Jimmy. You know I agree with you on this. We talk about this from time to time. I think what the viewers also need to know is that prior to this week's China news, Macau gross gaming revenue was actually shooting through the roof. I forget if it was August or July, but one of those months was the best month in Macau since COVID hit, and it's clearly going past the pre-COVID record. So you add on top of this the China stimulus. I think both Wynn and Las Vegas Sands are winners here. You know I like Wynn, though, just because I do like that Las Vegas exposure. I was out there last month in August, and I can tell you it continues to go gangbusters in Las Vegas, as it has for, frankly, several years now. So good call. I'm with you.
It's amazing. The
Thank you.
$62 spaghetti pomodoro at the Sinatra restaurant on the way is packed.
You want to have a beer poolside, fork out $18.
Yeah. And that's the 9-ounce cup.
It's a Corona.
Anybody here got a view on the casino stocks? Anybody? Bueller, something OO economics? Well, all right, so let's move on. Going into this market, I'm looking at these top performers, Jason, this week. It's not just, okay, Estee Lauder up 18%. United Airlines, thank you, Brenda, up 13%. Tapestry, which is the former Coach, up 12%. We keep talking about this consumer. I can't figure out the consumer, Jason. You're in Philly. There's certain things that are probably busy, certain things that are not. But it does feel like the higher end is still just dominating the consumer and the stock market.
There's no doubt that the consumer is hanging in. And I think, obviously, from a policy perspective and in an easing cycle, they'll be further stimulated. So I think, and you can pay attention to obviously some of the other discretionary names that I know we'll talk about, and we've been talking about the Walmarts of the world, the Targets of the world. There's been a lot of retailers that have done relatively well. Costco obviously is another one. So for me, I think it's still somewhat, there's obviously some divergence between the type of consumer, but I think all in, they're hanging in.
Yeah, I think on the consumer topic, I think we've seen a lot of retailers like Costco, TJX, those that appeal to a large variety of people and types of consumers, where you see the high-end consumer maybe kind of trading down or looking for a bargain, not necessarily because they have to, but because they're tired of paying so much for things. So I think we've seen this ongoing consumption with the low end, struggling a little bit, but overall, still very healthy.
Everybody's got a view on the gap, but just, I mean, the market divergence has been striking. I'm looking, Dollar General and Dollar Tree are down 33% and 31% this quarter. Walmart's up 18% this quarter. You think maybe they're the same consumer in some respects? Maybe they are, but when you have a 50% divergence in the equity this quarter, it's really striking. Stephanie, saw a big interview with Jim Mad Money, the new-ish CEO of the Gap, very bullish. I'm told denim is hot. I don't know. Maybe you do. What do you like about the Gap? You added to that.
Yeah, this is all about the management change. We're starting to see results. Richard Dixon went to the company as CEO in late 2022, and it sometimes just takes time for new management teams to make an impact, and I think he is. In addition to Richard Dixon, he hired a creative director for Old Navy and the Gap. He hired a new CEO for Athleta. He hired a new CEO for Old Navy, who, by the way, was at Walmart for 26 years. So this is all about new management, better execution, better product, inventory control, and higher margins. Their inventories are down 7 consecutive quarters, which means fewer promotions, and gross margins last quarter alone were up 500 basis points, and they're expected to be up 200 basis points in 2024. I think they're lowballing. So they've been gaining market share for 6 consecutive quarters, and back to school, I'm hearing, was very good for them. And also free cash flow is growing about 7%. So 11 times earnings, 2.9% yield, and a management change, I think, is really, really exciting.
Yeah, I mean, I saw the interview with Jim. Great interview by Jim, as always. The CEO, Richard Dixon, very bullish. The stock has done great. Stephanie Link, some good calls there. Appreciate your views. Thanks for phoning in on a Friday, Stephanie. We'll see you soon. All right, coming up, it is your calls of the day. We're going to start with a price target hike for one cloud stock. It's already had a big run. The name, the call, ahead. All right, let's hit some of your calls of the day. Let's begin with Salesforce, CRM, Wedbush, raising its target to $325. That's about $50 more upside than where the stock is now. But, Kevin, you just sold it in your QDVO ETF. Why?
We had a small position in our growth ETF, but we were looking at the revenues declining for 8 quarters in a row. We're very excited about the AI. We know how embedded their customer base is. It's hard, it's easy to get in, but very hard to leave. But we just think that there's a window before they can monetize it. We're going to redeploy the assets elsewhere and look to re-enter it later.
All right, on the flip side, you've got Walmart in your Devo, not the band, DIVO ETF. Citigroup just raised their target on Walmart to 98. That gives it, let's call it 18 bucks of upside. Are you adding more to the ETF, or is it just like it where it is?
No, I mean, I love the fact that there's a bullish call there. We're enthusiastic about the stock. It's one of our favorite names. When the consumer trades down in a slowing economy, Walmart can be a beneficiary. But it's expensive here. $98 is a little bit of a stretch. We know it'll get there. I'm just not sure when.
Yeah, I mean, I think you're seeing today's price action in Costco, and seeing that great results from a company that is highly appreciated make it hard for it to appreciate further. There's absolutely nothing wrong with Walmart or Costco, nothing at all. They've just had a lot priced into them already. And you were mentioning Dollar General and the other dollar stores earlier. I think there's just a wide gap between the customer experience. Have you been in a Dollar General?
I actually have, because when I go to rural Wisconsin, where I have a home, that's one of the main places where you would get Tide. But a lot of times they can be, and I know the stores vary, so don't come at me, Dollar General or Dollar Tree, but they can be a little bit, things are misplaced, there's stuff on the floor, whatever.
You get night crawlers there?
You can't at this one, but there's a great fishing and tackle shop actually right literally across the street.
Mom and pop has not been put out of business.
Not up in rural Wisconsin, but it is amazing. Is Walmart a retailer? And I know it sounds like a stupid thing to say, but Walmart's digital ad business is they're like, we're looking at you, Amazon. Walmart's they've done management. I think you got to imagine the management team has done a spectacular job with Walmart. Is that an overstatement, Jason, Brenda?
I think they've done a great job on the digital side, with growing faster than Amazon. So that's great. And then on top of that, you can't forget, they're also a staple. They're one of the largest grocer in the country. So they have, a lot to offer, I guess. It's not something that we own, but good.
All right, let's move on. Let's move on to sodas and snacks, because Pepsi placed on a short-term negative catalyst watch by Citigroup ahead of earnings. I have no idea what a negative catalyst watch means. I assume it just means watch it for potentially a negative catalyst. Either way, Kevin, you guys own it in your QDVO ETF, Pepsi.
Yeah, so I like the call. We sold it out of our flagship strategy about a year ago. And you say, well, why do you have it in a growth portfolio? What's the logic and the rationale there? Believe it or not, it's the 13th largest holding in the Qs, which surprised me.
Wow.
Yeah, crazy. But we own it. I'm not that enthusiastic about it over the short term. I agree with the call.
Okay, moving on quickly. Any time for Amgen? We have?
I wouldn't be a buyer of Amgen either at these levels. We have it in both of our strategies. It's a full position, but I think that they're going to be challenged. It's done well. I wouldn't be a buyer here on pullbacks for sure, but this call is a little bit premature.
Yeah, and the call, I threw it in. The call is Cantor Fitzgerald initiates Amgen as an overweight, a fancy word for buy. Our senior markets commentator Michael Santoli joining us with his midday word or words. Mike, what are the words of the day?
There'll be a few, Brian. If you look at a surface level, S&P 500 looks kind of like an indifferent session once again, although, really, if you look below, it's 3-to-1 positive to negative breath right now in the New York Stock Exchange. 3 stocks up for every one that's down. Consumer cyclicals outperforming up nearly 1%. Banks doing well again. Industrials doing well again. So it's really the story of the third quarter, which is, or at least the September, where over the last 3 weeks, we've had this recognition that the macro was maybe not as weak as we had thought. The market is pricing that in. Meantime, the old first half winners in terms of Magnificent Seven have not really done a lot to help. They're kind of hanging in there and consolidating for the most part. But today, that's what's suppressing the S&P 500. In terms of, I guess, general field position, we've gone 3 weeks basically in mostly straight up mode. S&P coming in today up 11 out of 14 days. We're up 6-7%. That's kind of the way these multi-week mini rallies go. So it wouldn't be surprising to see it take a breather, but the macro message looks okay still.
Macro message looks okay. I don't know if you're at the top of the show, Mike, but Kevin and others talked about how this is a market where a little price to perfection next week with all the stuff you just referenced. A lot of economic data. Do you think it has to come in not perfect, but nearly perfect to justify 23 times forward earnings on the S&P 500?
I think it has to generally validate the economy is not at stall speed and the consumer hangs in there. And obviously, yes, there have to be air pockets and hiccups, and you have to be aware of that around the jobs report. I wonder if it's going to be like 3 months in a row we're going to have a mini panic about this if the jobs report isn't perfect, because it seems to me it didn't feel smart to be selling out in the first week of either August or September in retrospect. So I don't know. I totally grant that, and I would say more like 22 times forward earnings. We are definitely based and priced on the basis of a soft landing scenario. So it's not news to the market that things are okay.
Michael Santoli with the midday word. Mike, we do certainly appreciate it. Thank you very much. All right, so up next, we're going to hit more committee stocks on the move. We got some news and trades on Costco. You got Bristol Myers. We've got more to do. 22 minutes left in the show. We're back right after this. Go back. Let's get some stocks on the move. We're going to start with Costco because stock is down about 2%. Jason, earnings beat. Revenue fell a little bit short.
Yep.
Stocks had a good run, down 2% today. You own it.
Listen, I mean, the stock's up 35%.
That's what I'm saying. 2% move down today.
Yeah, fine. It's trading at 50 times forward, so it is an expensive stock. And they get that multiple because of their annuity stream of their membership revenue, right? So same-store sales were up 5.4%. You know, a little bit of gasoline softness. If you X that out, same-store sales would be up 6.9. So again, I love this stock. It's been a juggernaut for years. You look at a 5-year chart, 2-year, 1 year, doesn't matter. It's done very well. So this is nothing that could be concerned about.
I think most retailers, if they could get a 6.9% same-store sales growth, they'd be dancing in the aisles.
100%.
And instead,
100%.
oh my God, it's a disaster. It's Costco.
Right. So it's a great company. They continue to do well and execute well. They're managing inflation well. So I like this one.
Palantir, Kevin, is the next stock. And Palantir, if you're not paying attention at home, Palantir is up 47% this quarter. Okay, 47% in a quarter. You had Alex Karp on with Bill Maher last week. He's kind of everywhere. But co-founder Peter Thiel, who seems to co-found everything, sold more of his stock. He sold about $1 billion this year, although we never know why Peter's selling anything, maybe to start another company. But you own Palantir. You got to be happy.
You can't begrudge a man for selling a stock that's up 48%.
Well,
it still has
sell
quite
it
a bit.
and build a giant solid gold yacht.
I think he has one.
Yeah, another one.
So forecasts are for 20% per year for the next 5 years. It's a small position, again, in our growth name. The other fun thing for us to be able to own some of these names is we're able to write covered calls on them. And the vol and the intensity of the volatility in some of the more technology stocks just makes it a heck of a lot of fun. They're easy to own.
Okay, this is some good news potentially for people that know people that are suffering from schizophrenia, because Bristol Myers Squibb, Jim, with drug approval, I didn't realize this. First drug approval for schizophrenia in decades. Yeah. So a lot of hope on that side, but the market also reacting with a 3% move.
Well, look, it's a serious disease. Bristol Myers made an acquisition, I think it was last year, maybe the year before, of Karuna, from which they got this drug. And I think we have to hand it to Bristol Myers for that acquisition. This is a stock that has been dramatically unloved. It still sells at below 8 times earnings and a 4% dividend yield. Many of us have scratched our heads at why exactly that is. Eventually, this thing is going to take off. I mean, after the 3% rise today, I think it's only up like 1% on the year. So there is plenty of room for this to run. I sold it around this price about a year ago. I might get back into it, but I'm still scratching my head on why the market hates this stock so much. It shouldn't be this hated.
Okay, well said on that. All right, coming up, it's a big story, folks. The largest port on the East Coast prepping for possibly the first strike in nearly 50 years. Frank Collin following the developing story live in Bayonne, New Jersey. What could be a very inflationary story as well. It's next. Over $2 billion worth, $2 billion a day, is on the line as workers in the East and Gulf Coast ports set to strike this Tuesday. We're literally a couple of days away, Frank Collin, from what could be one of the most impactful and important port strikes in recent American history.
Hey, good afternoon, Brian. You're absolutely right. As we approach that Monday at midnight deadline for that possible strike, we're seeing stocks that provide logistics and air freight services outperforming today as they have all week. That includes names like FedEx, C.H. Robinson, also a smaller cap company, Air Transport Services Group. Here's why. The International Longshoremen Association has said it will strike. The port operators known as USMX do not offer what they want when it comes to compensation and restrictions on the use of automation here at this port and the other ports on the East Coast and the Gulf Coast. Just yesterday, USMX filed a complaint with the National Labor Relations Board, accusing the ILA of not being willing to negotiate. The ILA denies those accusations. As you mentioned, over $2 billion in daily trade volume moves through these East and Gulf Coast ports. We spoke with C.H. Robinson, one of the biggest freight forwarders, about the supply chain impact of a possible strike.
Our usual rule of thumb is if you have 1 week of strike, you have at least 1 month of congestion and disruption.
Let me spell that out for you. A strike would create longer, more costly shipping routes on both trucks and rails as people go to different ports. And today you're seeing the nation's biggest trucker, Knight-Swift, and East Coast rail operator CSX, both of them moving much higher as their volumes and pricing power are both expected to get a boost. Brian, back over to you.
Frank, yeah, big story. Watch it over the weekend. Tuesday is the day. All right, so Brenda, you own UPS. I mean, this is one of these stories where I think the American public's kind of like, whatever, port strike. What if this happens? You're going to go to the store, and there may not be the thing that you're looking to get. Does UPS benefit maybe from this?
I think shippers have more exposure to air freight benefit because suppliers will be forced to pay for air freight to get things on the shelves.
Yeah. See, to Frank's point, like a C.H. Robinson Expeditors.
Right.
Where they get, just get it there, we'll pay whatever it takes.
I think the bigger risk for the economy is that this disrupts the inflation improvement story a little bit, although it's a temporary phenomenon, but nevertheless could throw a little bit of a wrench into it because goods have been a source of deflationary pressure within that inflation basket. So I think if that's disrupted, it'll make it a little harder to understand what's really happening with inflation.
All right, let's get back down to Frank Holland. Actually, I understand there's some new headlines. Frank.
Yeah, absolutely, Brian. I mean, just looking at the wires right now, the Biden administration says they're going to meet with USMX. Again, those are the port operators today. And also, they had earlier talks with the union earlier today. We have reached out to both of them. Haven't heard back today from them. The Biden administration obviously hoping to hold off a port strike. They have put out a statement saying they would not enact the Taft-Hartley Act to avoid a strike. That would basically allow them to ask the two sides to keep negotiating and keeping the ports open. The Biden administration saying previously they believe in the collective bargaining process and they're not going to enact Taft-Hartley, but now getting more directly involved. Throughout the week, I've also spoken with the Labor Department. They say they've been in touch with both sides, but again, the administration saying prior to today, this may be a change today, that they had no plans to get involved at all. I just want to go back to some of the other previous labor situations during the Biden administration. Remember the rail strike? They brought the two sides in with the labor secretary at the time. They didn't necessarily negotiate or get involved with mediation. They were more facilitators. They actually literally said they brought him in overnight, ordered some pizzas, and just said, hey, let's try to talk it out. Here we're seeing the Biden administration seemingly taking a more direct approach to try to get this situation resolved. But again, previously saying they wouldn't enact the Taft-Hartley Act. We'll have to wait and see. But we have reached out to the USMX and the ILA. So far, no response.
All right, Frank Collins, some important headlines there. Jim, let's hope this gets resolved because it's not what. There's an election ahead. This is not the kind of headline that the White House would necessarily want, politics aside. Any trade here, any play on this?
Well, this would be very damaging to the economy. It's frankly the sort of
thing. If it went on for a while, right?
Yeah.
Couple days.
You've already seen traffic diverted, shipping traffic diverted to the West Coast from the East Coast. By the way, Brian, you weren't here, but earlier this week, I sold Union Pacific and bought Wabtec. I know or believe that the economy is going to continue to grow and we're going to need to transport things by rail. But I don't want to be beholden to any one geography. I mean, this is a case why. Now, it happens to be that this will likely benefit Union Pacific, but that's the point. I want to be in Westinghouse Air Brake, which services all railroads everywhere. But, just back to the top, I really don't care if this is short or not. This is going to be damaging. You're absolutely right. It's a political hot potato at the worst time. And frankly, I think the union knows that. So, it probably has to be resolved very quickly.
That spells a little bit of leverage. By the way, Wabtec went to their factory 3.5 years ago, my election road trip, Erie, Pennsylvania.
That's a well-known railroad town.
Fantastic.
And just up the road from Altoona, Pennsylvania, another
the home of
railroad.
Sheets. Gotta go. Final trades next.
And a hardware, software, advertising, they're hitting on all cylinders.
Accenture, an essential player in the AI transition.
Practice that.
Yeah.
AbbVie, great pipeline.
Disney, thinking about what streaming profitability next year is going to be like, I think it's going to be a lot higher than expectations.
We had 28 seconds to do that, and they thought we couldn't get it in, and now we have just time to kill.
I know. What
Just
are you
sit
gonna
here
do?
and
Working
banter.
out?
Do the markets.
What are you doing this weekend?
Lots of Little League, lots of flag football. Thanks. I'll see you on the 4 p.m. show today.